In this video, as part of the Candlestick School series, we're going to look at the powerful reversal candlestick pattern called the shooting star. Stay tuned for this one, guys. Hey traders and investors, a very warm welcome to you. Thank you for tuning in. Okay, so shooting star, this is a really powerful one. When used right, it is very, very, very good. It's one that I think everyone should have in their trading arsenal in some form or another. Do you have to use it all day, every day? No, but you know what? Under certain conditions, if you want to be very, very strict with it, this thing is super, super powerful. Okay, so shooting star, let's just run through the definition quickly and then we'll look through some patterns, some real life examples, some winners, some losers, where our stop would be, how we would enter it, and most importantly, what I consider to be most important, the kind of overall market environment that we're using in, because for me, that's the key to all these candlestick patterns. Okay, so this is something, kind of an official definition of a shooting star. First of all, let's just draw it, and then I'll kind of talk you through this little piece that I've stolen from the textbook, so to speak. You've got this kind of pattern, basically. That's like the worst wick ever. Let me just remove that and put a straight one, just because it'll annoy me if I don't. This is basically a straight line, as you can imagine. I've still done it again. Never mind, let's carry on. This is the shooting star. It is basically a push to highs intraday. I'm going to use it on a daily chart for now. We'll talk about time frames in a second, but a daily chart for now. It's a push to highs that fails. So you open at lows, you push to high, you fail, you reverse, and then you have a close that's relatively narrow, or relatively close to your open. The official line is this. For the candlestick to be considered a shooting star, the formation must be on an upward or bullish trend, so it's at the top of the market. You don't get it in the middle of a range, you don't get it at the bottom, it's at the top. The distance between the highest price for the day, i.e. this part here, the high, and the opening price must be more than twice as large as the shooting star's body. In other words, put it into layman's terms, this bit here, okay, this bit has got to be 2 times this bit here, okay? So it makes sense, doesn't it? Because really you want to see good extension up that fails. You get that supply-demand shift, it fails, it rolls back over and then closes. So you've got that kind of really narrow body, but a really kind of big uptrend during the day that's reversed. That's the key. So the distance has got to be, you know, very, very small or doji type, you know, just literally a straight line. So now we've got the definition out the way. Let's clear that off. Let's look at some real world examples. Let's look at how we can make some money using this. Now, I want to add this little rules to it that I feel are the most powerful. If you're using it at the end of a strict uptrend, you must be careful, because as you are aware, guys, the underlying trend will most of the time force its way through multiple times before eventually it rolls over. You know, so if you're looking at it as a reversal signal, yes, you're going to be able to get that, but the probability of success at the end of an uptrend is going to be low, but your risk reward ratio is going to be high. So you've got to be comfortable with that. You've got to say to yourself, okay, I'm going to get stopped out 10 times on this, taking it at the end of an uptrend, but when I'm right, I'm going to get 20, 30 times my risk on it. That's fine. But I think the most powerful conditions for it are, in this example, one of these examples here, like on crude oil. Let's just remove that. We have a downtrend. Okay, we have a downtrend. Okay, we could scroll back and say we've got a downtrend from $90, $98, whatever it is here. But whatever time frame we're looking at, this is a downtrend. Okay, we've pushed lower. That's the key part I like to see. I like to see the weight of pressure in the direction I wanted to take the trade. This is, by the way, this is a short trade. If it wasn't clear already, this is a bearish candlestick pattern, and this is the textbook shooting star, so to speak. So here, let me just adjust that slightly. Here is a textbook shooting star. That is more than twice of the high there. That distance between there is more than twice the distance of the body. It's perfect. And do you know why else it's perfect? And which is the things that I really like to see. It's taken out prior highs. This is a beautiful, beautiful, beautiful pattern. It's taken out prior highs. Look here. There's our kind of prior high. And what I was talking about before I kind of got sidetracked on the actual pattern itself was this. You got a downtrend here. you've pulled back, so you've done some work back into the downtrend, but you've not really done that much work, and then you've seen it. So notice the difference. Uptrend, we see at the top of an uptrend, it's the same pattern, but if we see it on a downtrend that's curling back up, that's a retracement, it's far more effective because we have the weight of that supply, that overhang, still pushing down on it, even though in the short term, couple of months, we're in an uptrend. So this is it. This is the key thing, guys. We've broken through a high, which is very nice as well, because you know what happens psychologically, and put yourself in the shoes of the person on the wrong end of this. You've seen this downtrend happening. You see it bottom, you see it push back up, it kind of holds, and you see it say, you know what, I'm going to go long when it breaks that prior high. So everyone's all aboard and they've gone long, and it's gone quite a decent amount. It's gone like $1 through above that 50, happens to be $50 as well. They've gone through, gone long, I think all aboard. Next day, intraday, or the same day, it actually closes at lows, and you're thinking, that's not very good. So the extra juice with this shooting star pattern is the next day you get follow through like we've done on here. And let me just clear off some of these bits so we can see it clearer. The next day you get that follow through. That's the beauty of it when you see that. So you think about it, everyone's stuck long, they've gone long, they've bought the breakout, and even if they're stubborn enough to have not closed it intraday, then they're still going to hold it, they're still going to be there. And then as it starts to roll over, they're like, it's rolling over, I'm going to come out. And because shorts start pressing it, everything happens. So you've got that nice multiple pattern of the actual candlestick shape itself. You've got it breaking above a high and faking out, and you've got the weight of the downtrend on it. That's when it's at its most powerful. Okay, so entries. Let's look at another example in a second, but let's talk about entries. Entries for this is going to be on the close. So as it closes here, that's when you're taking it. You're taking it at the close of the same day. Your stop is going to be above the high, because in theory, you think about a stop is placed somewhere where the thesis of the trade is incorrect. And if the thesis of the trade is a reversal pattern, the thesis of the trade is going to roll over. If it should retrace and push up to highs, that thesis is negated. We don't want to trade, right? So there's your risk reward. Very simple. Sorry, your risk is very simple. Rewards, do you know what? This is the kind of thing that can run on a long time. You can get multiple day moves out of it, multiple month moves out of it. Especially if you're taking it in the context of a deeper downtrend, like this example here, where you've got that downtrend and it's a pullback in the downtrend. My first port of call is always going to be the prior low. Always going to be that prior low. Just because of the nature of where we are. So this is why it's most powerful when it's in this environment. And this is a really good textbook example of all those things combining to give you that real juice in the trade. All right, let's look at something else. So that's your short entry, and the stop is there, and of course managing it as you see fit. Let's look at another one here, guys. This is on cable, GBP USD. We've got a slightly different scenario here. We've got a bit of a range environment. But again, whilst I feel that the most power comes in when we've got a downtrend and we're retracing and we're still within the broader downtrend, and I think the uptrend is a little bit dangerous, but okay, as I mentioned, risk-reward ratio might make up for the lower probability of success. When we're in a range, again, this is equally as powerful, especially when we're breaking key levels. Look at the highs here. We've got kind of multiple highs tagged, and then we get the breakthrough. Let's zoom right in on this bad boy. Let me get here, let me go here, that's better. Look, we get exactly what we like to see. We break above that high, we break above a kind of high from a week ago, break above a high that we saw back multiple months ago. Significant level, everyone's watching it, all aboard. We fail, and then we get the icing on the cake, which is the second day follow through. Now, do you have to wait for the second day follow through to go short? I don't think you do. I think you're okay going short on the close of that shooting star. You've got the attributes here, like the body is very small relative to the high to close ratio. Those two are very decent size ratio. The next day is like like an icing on the cake, or cherry on top, however you want to put it, whatever analogy you want to use for that. So you're going short on the close, your stop is going to be there, and you're looking to roll it. Now, am I against someone taking some off the table and you get 1 or 2 day move, good pulse in your direction? No. If you want to scale some out, then that's all good and fine by me. But make sure you don't undersell yourself, and make sure that if you're waiting for this to form, and you've got a broader kind of setup like this where it's just struggled. Don't sell yourself short. This thing could give you a multiple hundreds, thousand pips move. and then you're getting very, very high risk reward ratio. And you can look at these and say, hey, I'll take these all day, every day, under the right conditions, because, man, the probability of success is pretty good when I've got the downtrend behind me, or if I'm in a range and I'm on a key level, and the risk-reward ratio is powerful as well. Why would I not want to take it? Regardless of what you think about it, it's like those two things are in line with me. I'll take it as long as I keep my risk managed. I'm all good. All right, so there's a couple of examples, guys. Entries, talk about exit. One more thing is time frames. Works lovely on a daily, works lovely on a monthly or weekly. Markets, every market, because this is a kind of, doesn't rely on a close as such. It works well for currency pairs, it works well for your stocks, your indices, your treasuries, whatever else you're trading. It's just that kind of intra-candle change, especially when you combine it with a breakthrough of highs, especially when you combine it with a downtrend, as I've already talked about. So animals for markets, time frames, it's good on a daily, it's good on I think it's good as well going down to a 15. I think you've got to be careful on a 15. I think you'd be very, very strict with your conditions. You want to see that downtrend. You know, let's say an intraday downtrend or 3-4 day downtrend, a push back up, struggling, push back up. Then you get that shooting star on a 15 that's within that kind of sphere of market conditions. You know, that's fine. If you're kind of stretching it and you're on an uptrend and it's happening, or it's a bit loose, it's a bit grubby, you know, I'd be careful. Generally, my thought is the lower the time frame, the more strict, or the stricter you have to be with the conditions to take it. You know, have we got one as a stop out? Okay, there's probably one here. I can't remember if I think I rubbed it out when I got rid of all the stuff, but for an example, I think we've got one here. I just kind of spotted one here. Here you go, here's one here. There's a shooting star just about, I'm not sure if that's a criteria, let's assume it is. Your stop is going to be there. So look at that, you know, even though it went in your favor, let's say you didn't take it off, you're stopped, it's not the end of the world. If you look at your stop compared to what you're gaining when you get it right, it's one of those patterns that definitely worth take more investigation, and definitely worth kind of defining the exact criteria you want to take it and bolting it into your trading arsenals and trading setup. All right, guys, hope you enjoyed the video. See you in the next one. Take care. Keep your risk managed. Goodbye.